All right, welcome everyone to the May webinar of the NZGDA. Today is a conversation that I'm personally really excited to hear about. We have Jamie Reidie and Wade Pearson who will be talking about the legal and accounting side of game development and setting up your studios, which is an area that I think a lot of people can take a lot away from. So we have some experts here today. Jamie Reidie is a partner at Paulson Higgs Business Advisors, and Wade Pearson is an associate at Galloway Cook Allen Lawyers. And they have a great presentation prepared for us to talk all about what it is that they're experts on. So before we get underway, just a few things to note. This call will be recorded and put onto our NZGDA YouTube channel, hopefully within the next week. We do have a Q&A at the very end. So if you do have questions that pop up throughout the presentation, feel free to put them in the chat or just hold on to them until the very end. Jamie and Wade might answer your question throughout, but we'll have a section at the end that's just for Q&A. Other than that, I'd like to pass it over to Leanne Ross, who's our Executive Director at the NZGDA, and she'll give us a nice opening karakia before we get started. All right, over to you, Leanne.
Thanks, Carl. Wade and Jamie, I obviously already know well. Hello to you both.
Hello.
I had the pleasure of serving with both of these fine humans on the Startup Dunedin board, so I know that they absolutely know their stuff. And Wade in particular is taking time away from a new baby and his Pepe to be here with us, so we really appreciate your time, Wade. But on behalf of NZGDA for coming and being with our community today, I'll do an official opening to welcome you on behalf of everyone else. Whakatakateo ki te uru, whakatakateo ki te tonga, kia mā kina kia, kia mā taratara ki tai, e hi ake ana atukura, he this morning. I'll hand it over to you both.
Thanks. Oh, thank you, Leanne, and thanks for having us. We're really excited to be here today. And as Carl and Leanne have said, we're going to talk about the legal and accounting side of setting up your studio for game development. So today we're going to talk about a few things that are really early decisions that pay off later. So they're not necessarily things that will make or break your studio, but they can definitely increase or reduce value and make life easier or harder for you. Ultimately, if you have enough money to keep going and you make a fun game, it's going to be 80% what you need, but these sorts of things can be really important too. Some of these you can do yourself, and some you do need professional advice. So we're going to talk a little bit about the barrier or the line between the two. Ultimately today, though, really what we're trying to make it clear is that legal and accounting doesn't have to be scary and complex and expensive. It's all doable, and it can even be fun, at least fun for us. It's probably stretching it a little bit, but we'll see where we go. So a little bit about us before we get underway. My name's Wade Pearson. I'm a lawyer at Galloway Cook Allen. And this is my family here, my wife, Reidie, my son, Elliot, who's 2.5. And then, as Leanne said, we've got wee Macklin, who's 1.5 weeks old. So if I appear a little sleep deprived, it's because I am. And I promise if I have to go change a nappy, I will turn the camera off. You don't need to see that. So in my day job at Galloway Cook Allen, I work with startups and businesses, and I do a lot of contracts and investment and fun things like that. I work with a lot of game developers, which I really enjoy. I'm a gamer myself, mostly PC and board games when I have time, which is not at all at the moment, but occasionally, and at some point I will. I'm also on the board of Startup Dunedin, as Leanne said, and we're a non-for-profit trust that aims to grow the startup ecosystem and support founders and startups in Dunedin. And as I said, I'm lucky enough to have Jamie Reidie on the board with me, and I'll hand over to you, Jamie.
Thanks, Wade. Morning, everyone. I'm Wade. Here's my family. I'm married to Garth as a primary school teacher here in Dunedin, and we have a 19-year-old son, Harold. Unlike Wade, we skipped out the baby, toddler and child phase, and with Harold coming to us when he was 15. So we dove straight into the teenage years, which was a bit of a challenge, but we're still here and surviving. We also have 2 dogs, Albie and Ralph, to keep us entertained. I'm a partner at Pearson Higgs here in Dunedin, and we work with clients throughout New Zealand and some overseas as well. And I look after people right through their business cycle. So particularly startups, but working with them right through their business. They start up, mature, sell on, and on into retirement and their other plans with their families. I'm also on the board with Wade, as he said. I've also been a facilitator and judge at Startup Dunedin for their Audacious and Co-Starters programs. And as well as all that stuff, fun stuff, I also chair the Theatre and Health Education Trust based here in Dunedin, also known as Theta. It delivers a program called Sex Wise in high schools throughout New Zealand. That's me. Right, we'll dive straight in, and I'll just go through a wee bit of an agenda. So we're just going to talk about we're going to focus today on sole traders or companies because in our view, I guess they're the most common and the most used and the most useful as well. We'll also have a bit of a discussion about working with co-founders and the things that you need to be aware of, the things that to encapsulate the broader term of workers. We'll speak briefly on intellectual property, but only in very general terms of what to look out for. Wade or I are intellectual property experts, but we can sort of point you in the right direction. We'll talk about taking on money or investment and what are the things to look out for, the things that you should know before you sign up for anything. And lastly, we'll also talk a little bit about choosing advisors. So we'll give you some tips on what to look out for, what you can probably do yourself, and what really needs some serious professional advice to make sure that it keeps you out of trouble. Okay, I'll dive next. So sole trader or company, we've summarized it here with basically thinking if you're still freelancing, still effectively doing development work for other people, you're probably okay as a sole trader. That's not to say that you have to be, but that's a comfortable space to sit in when you're doing that sort of work. But if you want to grow and start to develop your own games or your own studios, you probably need a company. And we've got a little postscript note in there, the earlier the better. So if we can get everything lined up as early as possible, nice and tidy, when things are small and easy, it's much easier in the long run. And generally before the release of your game would be the best time to get your ducks in a row. So there's lots of options for things that for legal entities or business entities. You can operate your studio with sole traders, partnerships, limited partnerships, joint ventures, trusts. There's all sorts of things, but we're going to focus today on sole traders and companies because they're the 2 most common things that we see in the industry. So some of the things that'll drive your choice of structure. So how easy is it to transfer ownership and make sure that your studio continues on into forever, maybe? And it's also about the ease of transfer of ownership, which is why we would choose something like a company and we can also helps to minimize tax costs of changes in ownership. So that's always something to have in the back of your mind as well. That some things can trigger unintended tax consequences. So getting that, which is why we've gone with the earlier the better. So because some things we just can't undo afterwards. It's for things like asset protection, protecting you from creditors, lenders, other family members, and potentially from future tax changes. Your structure will help you with funding. So if you want to raise debt or equity, which we'll talk about in a little minute. And income splitting and tax efficiency is also something that we as accountants think about when we're setting up companies, particularly when they're smaller, closely held companies, family companies, etc. And market perceptions is something else. So companies are generally seen as the most accepted commercial vehicle for business. So that's why companies get used. But if you're still freelancing and doing work for others in your own name, as an individual, a sole trader is probably still the best option. Sorry, we'll go to the company pros and cons in a minute because there's more of them. So a sole trader's got the lowest startup and compliance costs. Anybody can just go out tomorrow and get straight into it as a sole trader. There's no requirement to advise anybody. There's no requirement to do anything to get you started. You're just going to have to file a tax return. All your income's available directly to you. You can claim expenses against your income in your tax return. And there's no legal separation between you and your business or your work, I guess. The downsides, you've got unlimited liability from a commercial point of view. The success or not of what you're doing is all attached to you directly, and it could be difficult if you need to take on a team or take on investment because everything's really tied into you. Your private assets are exposed when you're a sole trader. That's probably the things that people think about the most is the fact that there's no separation between you and the business, so it's all up for grabs, and there's very few opportunities for income splitting. So income splitting, that in most of the cases that we deal with at the smaller end is income splitting between you and your significant other or other people that are working with you. When it's just you running the business, for example, and you've got a spouse who may be doing some work for you, you actually have to apply to IRD for permission to pay them. When you're a sole trader with a company, it's a bit easier. So some of those things to think about. But when you want to fly and you want to grow and become established, or are thinking about taking on investors, you'll need a company. And the earlier you do that, the better if you've got growth plans. So companies, pros and cons. The big pro for companies is that they have limited liability. And I think most of us sort of have an understanding of that. There's less personal risk for you, which is one of the main advantages. But if we've got to borrow money or we're borrowing money ourselves, or it can get eroded because most lenders will ask you for personal guarantees and or security on your loans. So that's just something to be aware of, that it does get pulled back a little bit, but it does protect you from commercial risk to a certain degree. There's a button there which I'll get to. So unfortunately, it allows for growth. So a company, separate legal entity, can live on forever, in theory. It allows you to take on investors, whether it's new shareholders. You can bring your workers on as shareholders if you want to, and share some of the success with them. You can offer debt and shares to the public, which is as well, there's other rules that govern that stuff, but it's an option, and it just gives the most convenience and legitimacy. So that's what people are used to dealing with companies from a commercial point of view. They've got their own life as a separate legal entity, so they can go on without you, or you could still be the shareholder and you can employ a management team and other people to run it for you. It gives you the most options in the long term. So because it's a separate legal entity, it does own its own assets and it can raise its own debt separately from you as an individual. But there's a few cons. So to go with this wonderful thing called limited liability, there's a lot more compliance. So companies are governed by their own law, the Companies Act, and also the Financial Reporting Act. So they've got to maintain a much higher level of record keeping and reporting. And to go with, I guess, saying that, commercial entity, it separates everything from you as a person. Most of us, particularly in the early stages, will be a director as well. And directors have got some, this is my butt, have got some requirements to meet. So you've got a duty to act in the best interest of the company, and you've got to meet all the company's legal requirements, whether you know what those legal requirements are or not, which is the tricky bit sometimes. And there's some pretty stiff penalties for not meeting those, and we've seen some of that in the last few years. Probably the most notable one was and I can't remember the other directors, but Jenny Shipley is the most notable one for Mainzeal, where things went wrong. And correct me if I'm wrong, Wade, but the broad thing that went wrong in that company is that they made decisions which turned out to be wrong. The company collapsed, but they'd made decisions when they probably hadn't taken in all the information and all the requirements. So they got out of their depth, probably is the summary on that.
Yeah, I think that's where you can go wrong as a director. You need to be kind of questioning things and making sure of things. And in that case, they had a loan from a major shareholder, and they kind of went, oh, okay, yeah, that's fine. They've given us their word. They wouldn't break that. And as it turns out, that word wasn't very strong or very useful. And so then the company ran out of money. And that's kind of the other thing I say is when everything's going well, you might be okay.
Yeah.
When the company runs out of money, if the company runs out of money, everything you do gets put under a microscope. So what might have been fine when things were good is not okay when things are bad, and you can end up with, like I said, personal liability. You lose your house. That's not great if you've got one anyway, given the current market. So it's definitely something to think about anyway. Back to you, Jamie.
Yep, thanks, Wade. So companies are pretty easy to set up. You can do it yourself. Flip to this one. Through the company's office website, it's about $150. But on the other side of it, they can be pretty hard to get rid of, particularly if they've been trading for a few years. So you definitely need professional advice before winding a company up or liquidating it or just walking away from it, because we have and do deal with quite often some fairly hefty tax implications if people haven't done the right thing as they've gone and when they come to get rid of a company. So do just bear that in mind, and it goes with that whole bigger compliance picture. So it is where, even if it's a conversation with an accountant or lawyer before you head off on setting up a company, just so you understand what's going on. So if it's just you getting up and going, or you and a couple of others, you've sole director and shareholder, you can do it all yourself. The website walks you through it. There's forms to fill out and sign, etc. But if you've got a group of people, then it could be worth getting advice, and we'll come to that in a little bit. Things like shareholders agreements and things. Please don't set them up with one share, because it's really hard to try and sell part of your business when there's only one share in it. So generally speaking, the more the better. We've put 120,000 plus, partly because numbers like 120,000 can be divided by uneven numbers as well as even numbers. But have it, if you're the only shareholder, if you've got one share or 120,000 shares, it's the same. But when you come to try and bring others on, it's a good idea to have more shares than not enough, because there's legal processes to go through for issuing more shares. You've got to have a unique company name. You can check it at one check, and if you've not sure about setting up a company, you can reserve a name for a period of time through the company's office as well, and they'll tell you when you do that if the name's not available. And you don't necessarily have to trade under the company's name either. So there's lots of companies that trade under a different name than the name they've registered. So that's like a super fast flyover of companies. We'll get a little bit more detail as we go, but Wade's going to talk to us about co-founders and the discussions you need to have now. Wade.
Thanks, Jamie. So if you have co-founders with your other people who are in the business, it's one of the leading causes of business failure when you have a big falling out and a big dispute. So it's definitely something to think about. Going to see a lawyer or an accountant won't solve all your problems, but it might help. I say you need a shareholders agreement if you have co-founders or investors. You might get by without one for a bit, but it might also end really badly. And the way I liken it to a prenup or a contracting out agreement. So if you're thinking of getting married, and this is not relationship advice, don't ever take relationship advice from me. Not that I'm bad at relationships, I just don't know how I've done it. I'm very lucky. If you're thinking of marrying someone, you want to at least be able to talk about, well, if we split up, what would, how do we do things? What would that look like? And if you go to have that conversation and it's really awkward and you end up screaming at each other, it's probably a good sign to not get married. And it's the same with a business. Entering into a business is kind of like having a relationship. So you really do want to make sure that you can actually have sensible conversations around the what ifs, because things always change. And even though you're great friends now, things will change and things will get hard. And then if you haven't either got a written shareholders agreement or at least a good understanding of how things might play out, it's going to make life a lot more difficult. So you need to ask yourself questions around, how are we going to make decisions? Who are the directors going to be? Are there certain thresholds, when we all need to agree, or when only 3 out of 4 of us need to agree? You want something that's both flexible but also has some protections, and that can be tricky getting that balance right. You want to talk about if we're bringing on new shareholders or investors, or if someone wants to leave, if someone wants to sell up and exit, if their heart isn't in it anymore. And also, if you have a falling out, and looking at what can happen and what can go wrong. There was a case recently, which is really interesting. I think it was a ferry business, and it was going to be selling for $100 million, which is not bad for 10 years of work. And there was a 2% shareholder. So he was going. Let's call him Bob. Bob, the 2% shareholder, he was going to get $2 million. And they said, hey, we're going to sell to this person, we're going to sell the whole company. And he said, yep, that sounds great. And then they went and got all the documents ready and said, here's the thing to sign. And he said, you know what? I've been working really hard. I think I deserve 4 million instead of 2 million. And they said, well, no, you've only got 2% of shares, so you get your 2 million. And he said, well, you need me to sign this if you want the sale to go ahead. So either pay me another 2 million or I won't sign. And they kind of realized, oh no, that's what we have to do. So they paid him the 2 million, and the deal went through, because otherwise it would have fallen over and they wouldn't have gotten anything. And then obviously, as you do, after they've paid across the money, they then sue him to recover that 2 million. And they kind of said to the judge, like, this was blackmail, this was extortion. And the judge basically said, well, yeah, kind of was. And it's morally pretty bad. I'd call it a something move, but I'm trying to keep my language pleasant. It was a pretty nasty thing to do, but it was perfectly legal. And that's how company law works in that instance. So the guy didn't have to pay the money back, and they'd spend a whole lot of money on the court costs, etc. That could have all been avoided if they'd had a shareholders agreement with, about 3 sentences in it. It's called a drag along clause, and that probably would have avoided the whole issue. So there are really instances where having a shareholders agreement is really important, and can save you. So look, this could be a whole hour-long talk about shareholders agreements, so I'll spare you that for now, but they're worth having a look into. If we go to the next slide, there are a few other things to think about with co-founders, which is really at those initial stages is, what are we all going to be doing and what do we get for that? So how many shares do we have? If there's 4 of you, do you each get 25%? Or does one of you get 50% and the others get whatever the mass is of 50% divided by 3? What are you all contributing? So, you want to be really clear around what your roles are, and that will change over time, but the more you can agree that up front, the better. And that's from a business point of view too. Also think about the amount of work you're going to be doing. If someone's going to be doing 50-hour weeks and someone else is going to be kind of doing 5 or 10 hours a week when they can, then is it fair that you're all remunerated the same amount? You'll get the same amount out of the company. If someone's bringing in intellectual property, maybe they've made another game and you're going to make a sequel with this, then, should you be putting a value on that intellectual property? And if others are putting in cash, then how do you value that? How do you make sure everyone's kind of even or equal? That's something where it can be really helpful to talk to an accountant or a lawyer about, or both, preferably. And if you don't get that right, you can end up, later on, you go, well, I've put in $50,000 of my own money into this company and now I want it out. And you realize you can't get it out that easily, or you have to pay 20 grand of tax on it. You go, well, that doesn't make any sense because that wasn't actually income, and it can get really messy, right? I've put up there vesting. Yeah, I put up there vesting, and it may be a term you've seen before or maybe not. Effectively, it can be a mechanism to make sure people do the work you expect them to. So the idea is, you give people shares, give isn't the right word, people have shares and they're going to do some work. And then if they don't do that work, if they leave after a year, then you can maybe take those shares back, or you don't give them more shares. That can be bad when you do it wrong. To put it simply, if you don't set it up properly, you get into a whole bunch of issues. Company law is relatively complex, and you can think you want to do something and then it just doesn't work, and that's not great. So do get some advice if you're going to be doing any form of vesting. If you're taking on investment as well from a venture capitalist or someone, they're probably going to want you as the founders to be locked in, and that's another area where you see vesting. So you want to really understand what you're getting yourself into. So also think about how you're getting paid, whether you're going to be paying yourself salary or you're going to be a contractor and you're going to have some service fees coming in that way. Make sure you do pay yourself if you can. It's fine to kind of sweat it out a little bit, but if you are looking for investment, that's something investors will look for is, are you actually getting paid? Can you actually pay the mortgage or the rent? Because if you can't, then that's going to be a risk to the business. And it seems counterintuitive, but it's actually a good thing to be paying yourself a certain amount. A certain amount anyway, not too much. Also think about the end game of, is this going to be a company that makes one game and then gets a steady kind of dividend stream and royalties and you just get a little bit of money, or are you looking to grow and get bigger and bigger and then you sell to Embracer Group or Activision Blizzard or EA or whoever? I won't make any more comments on that. But if that's the goal, then that looks quite different to kind of a sustainable business that doesn't have as many staff and doesn't have as big kind of growth plans. So we'll go on to the next slide. And I think we'll be Jamie talking about workers.
Hey, so now we've decided that you're going to get paid. How do you get paid? So I think the main thing that to understand if you're going to be taking on people is, are they an employee or are they a contractor, which is is a thing that comes up a lot from or it's something that's in the government's mind quite a lot, because they generally feel that people employ people as contractors so they don't have to treat them as well as they do an employee. So it's something that they do look at from time to time, and so make sure that if you're going to take someone on, you understand if you want them to be an employee or a contractor. And I suspect that most of you are sort of aware of that, particularly if you're freelancing around being a contractor, you'll understand that differentiation. The difference for an employer, for want of a better word, or for somebody hiring workers, to give it a more generic term, is the employer's got a much higher level of obligation and care that an employer has to take. You're going to have to allow for things like sick leave. You're going to have to allow for holidays and pay them for those holidays. You're going to have to pay KiwiSaver on their wages. And you've also got an obligation to look after them from a health and safety perspective and all those other, the softer things that come with being a good employer. So that it's important to make sure to know that you've decided in your mind what you want to do. It's not to say that you can't give some of those things to contractors. It's just that you're not legally required to meet a certain level, I guess. But in either circumstance, you want to make sure you know where you're positioning yourself as the person doing the hiring, and that you can communicate clearly what the expectations are to whoever you're taking on. And that's why you should have a written agreement. Always. But we say it always to everybody, don't we, Wade? And people still come in with no written employment agreements and no contract agreements for contractors. So there are templates out there, and we've got a website at the end for a law company based out of Wellington that does provide some pretty good templates, but there are other ones around. There's information on the Department of Labour website, so it is worth taking a little bit of time. I have seen people get sued for treating people as contractors when they should have been employees, and it's pretty costly. So be aware. And now for the reason why we've got a picture of Hobbiton on this slide, which I'm sure is what everybody is wondering at the moment and not listening to me. But anyway, there's something called the Hobbit Law, which the gaming sector currently comes in under, which was brought in effectively for the filming of the Lord of the Rings movies, where people who really were employees were able to be treated as contractors. And I think that was primarily because of the way the film industry works, but it didn't quite line up with New Zealand law. So an extra bit of law was written in, but be aware that it is being reviewed because the governments really don't like the whole employee versus contractor thing. And I see that Leanne's posted in the chat that they do have some business resource templates. She's
From 2023, yeah.
So employees must have employment contracts by law, but you should always have a written agreement for any kind of contract arrangement as well. Now, profit shares, employee share schemes, paying people with shares instead of money is a whole big, horrible mess. People, and I guess we've seen it a lot, a couple of people start off together, working side by side. We're developing a game. We're sort of, let's getting there. We're gonna sweat it out, as Wade said earlier, and we're gonna take some shares. Is how we're gonna get paid. Then it turns out, oh, hang on, I reckon I did 80% of the work. You only did 20%. So all these things start to come, which is partly your co-funders' work as well. But if you've decided to promise somebody shares as part of their remuneration, like we'll take you on for this amount, whatever, 50 grand a year, and once the game launches, we're going to give you 10% of the company. All of that stuff, one, it's got legal and tax implications, so you need to be aware of that. And two, is it can get messy, because you might say, for example, we'll give you 20% of the profits. Then we get to the point when the worker says, I want 20% of the profits, and we're going, oh, well, this is what we think the profit is. We've taken these things in and out. It really does get messy. So this is a point where we've said, don't DIY this. If you want to formally put it in agreements, you do need advice from a specialist. And employee share schemes are the same, because you have to set aside a percentage of your shares, based on a percentage of your company that's going to be available to employees. There's considerations around having clauses for if they have to sell them back to the company when they leave, a whole lot of stuff. And it has legal and tax implications as well. So that's one that is complex. So that definitely needs some help.
I think at best, if you do this and you get it wrong, you end up paying 20 grand in legal fees when you could have paid 5. Which is bad, but it's not the end of the world if you're making enough money. But at the other end of the scale, it can be. I mean, I've seen a business fail. They did a whole lot of things wrong, but one of them was paying a whole lot of people in shares. And even though they got a whole lot of legal advice for free, it took up time and effort and money, and you had 14 co-founders, and it was just a mess. Wow. So it is really. That can be one of those kind of business killing decisions if you get it wrong. Not to scare you too much, but just take a bit of care with those 3 things.
Yeah. And just be mindful that if a true employee is foregoing wages or getting paid less because they're going to get paid with shares, those shares will get treated like money from a tax point of view. So they will have to pay PAYE or tax on them. So yeah, you can't just say, oh, look, haven't paid you enough, or we're going to give you some shares. It does have tax implications. So please ask for help or advice, or at least go into it with your eyes open is probably the question of what, and that's, I guess, somewhat what we're trying to get through today. So make sure you understand your tax and payroll obligations. IRD takes PAYE pretty seriously. And they don't, and saying I didn't know I had to do that is not an excuse. There's heaps of third-party providers that can help you in terms of, you can outsource it completely. You can use online sort of semi-automated systems like Thank You Payroll, iPayroll. I've got Xero listed in my compliance tools there. Xero does have a payroll add-on as well that you can use. It does most of the heavy lifting, but not all of it. If you use something like Thank You Payroll, iPayroll, or an entirely outsourced payroll provider like I don't know, Pearson Higgs maybe, then
they're really good.
Yeah, they will do all of it, so they'll make sure that you're compliant with the rules basically. Whereas if you use something like Xero Payroll, it'll do the processing, but you've got to make sure you're putting the right information in. It can be more complex with overseas workers. So just make sure you know if you're taking on somebody what your New Zealand tax obligations are towards that person, if any. I'll say if any, because sometimes there's none. But it really, especially if you're taking them on as a contractor, it's their responsibility in their overseas jurisdiction. It's not yours. But there can be, it is worth, particularly if you're going to be taking on a number of employees, it is worth making sure you're not going to be considered an overseas employer, et cetera, because again, more compliance. So if you've got employees and contractors, you might have some PAYE and withholding tax obligations. So even though you're paying them as a contractor, depending on the arrangement, you may have to deduct withholding tax and pay it to the IRD on their behalf once a month. There are IRD calculators if you're trying to work out what your total cost of payroll and things might be. So do use those. Be aware that there's also ACC gets tacked onto your payroll once you file your tax returns in New Zealand. Yeah, so I guess particularly from a small business point of view, my recommendation would be use Xero for keeping your records together. You can attach your bank account to it so it comes in automatically. It's the easiest one to use. There's lots of training resources on the internet and through Xero itself. It also can deal with multi-currencies if you're dealing with offshore income. Very well actually, in fact the best that I've used, so from a small business point of view. So definitely look at that, because you want to, even if you're still on the cusp of moving into full-time, I'm developing a game thing, you want to be keeping all your expenses and all that stuff, gathering that information, because it may become useful once you get underway. Yes, that's hiring workers. And obviously, if you need to drop them off the other end, that's a whole other ballgame, particularly if they're employees. So we've had an interesting experience where we worked with some New Zealand employees of an American company, and the American company was restructuring or closing down, and they were like, tell everybody not to come on Monday. And we were like, whoa, no, you cannot do that in New Zealand. So make sure you know what your obligations are. So yes, that's an important one. Righto, IP, Wade.
Right. I was just going to say with employment as well, it's an area where you can more easily get into a fight and more easily get sued for money. So a lot of the commercial stuff, there's an effect, but it's kind of a bit woolly. It's very rare that I'll be working with a client and say, if you do this wrong, you're going to lose $60,000. Whereas with employment, if you're going to just tell someone to not show up on Monday, you probably will get sued and lose quite quickly. So it's definitely worth paying a bit of attention.
I think it would be fair to say that most commercial contract disagreements would end in some sort of negotiation rather than employment ones, which have got their own structures to go through employment authority and things, isn't it? Yeah.
So intellectual property, we're coming up to Q2. I think we're probably going to go a bit past 12 o'clock. If anyone has a hard stop, we'll be here until quarter past, depending on questions. So I'll be relatively brief with this. Intellectual property is obviously very important if you're developing a game. The key sources of where your IP comes from will be your workers, your employees, your contractors, and co-founders like you and others. If you've done everything we've been talking about to date, if you've got a shareholders agreement, if you've got employment agreements and independent contractor agreements, probably you're okay for the basic step of making sure that all the IP is owned by the company. If you've hired people without a written agreement, you may have a big risk. And we've had a company that was selling for about, I think, 20 million was the offer on the table. When they did a bit of due diligence, the purchaser found that there were a couple of people who had worked on the code. This is a software product, worked on the code in the early days, but without any written agreement. And arguably, they might have actually been able to claim some of that IP. And that was just too big of a red flag and too big of a risk for the purchaser. So the purchaser walked away. And so it can be a really big issue. And it's one of the annoying ones because you might think you're totally fine at the moment. And then 10 years later, after, blood and sweat and tears of hard work, you find out that you've, made a bad decision that's really come back to bite you. So it is really worth putting in a little bit of effort now. You don't need to go to a specialist IP lawyer and spend 20 grand to do that. You just need to get some of the basics. Licenses I've put up there too, in terms of tools and assets and things going into your game. Hopefully you understand, maybe even better than I do, copyright and copyleft and OGL and all the different kind of licenses and things as to whether something you can put into your game or not. Obviously, don't just, grab a picture of a Pokemon and put it into your game. That is going to be breaching Nintendo's copyright and you'll get in a lot of trouble. Hopefully that's so obvious I don't need to state it, but do, make sure you understand that. And like I said, that you can do a lot of research yourself online and talk to others and figure it out from there. Apart from that, kind of the basics, to me, I'm trying this metaphor out. It's kind of like a meal. You've got the plate and then you've got the meal on top, right? And getting the IP assigned to the company, understanding licenses and things that are going into your game, not breaching other people's IP, that's kind of like plate. That's the bare basics. And even a commercial lawyer like me who knows a fair bit about intellectual property, I can help with that. If you're then looking for the plate, the meal, the main event, which is, your trademarks, your heavy registered IP, that's something you want to go to an IP specialist for. And I say make an IP strategy early, as in have a think about it, have a talk to others, talk to other businesses that are similar to you, have a look at what others have done, and decide from there, what do you actually need to protect and how much you need to spend. Because doing a trademark in New Zealand, you can do it yourself. The value it gives you is a certain amount, whereas if you are really serious and you think you've got a good shot, then you want to look at other markets like US or Europe or China or wherever, and you want to look at all the timings and all the costs, and it does ramp up quite quickly. So have a think about it early. Whether you actually go and spend a whole lot of money early is a different question. You probably want to at least have some idea that, we're onto a good one. This is going to be a good game. This is going to make some money. This is going to be fun. People are going to want to play it. Do some validation first, I think. And you may have heard about things like separating out into an IP company and a trading company and maybe a holding company. If that doesn't make any sense, that's fine. You don't really need to worry about that now. It's something that's good to do down the track, but in those early stages, you can end up spending money without really needing to, and that's something we hopefully want to avoid. So, moving on from intellectual property, we're going to talk about taking on money and investment. So, there's, again, this could be an hour or two. Simple tip is get professional advice if you're taking on more than $10,000. So below that, it's probably not the end of the world if it all goes pear-shaped, but anything kind of decent, you want to get it recorded in writing as to what that is. Is that just a loan? Is there interest? When do you have to repay it? Are you giving away equity in the company? Is it some kind of convertible hybrid instrument, which may sound confusing and complex, and that's because it can be. Is it just a grant? What are the terms of that grant? What are the restrictions? Even if it's your own money, it is really worth understanding and recording how that money is going into the company. If you don't, you end up in a bit of trouble. You end up not being able to get the money out. You end up breaching the terms of a contract. You might think, cool, I'm good for 5 years, but then actually they can call up that debt, and then suddenly you've got to repay money that you thought you didn't need to repay, and that's really painful. I put advances there. If you're working with a publisher, they may give you an advance. And then there's, I mean, again, that's a whole nother hour or two. And if you do that, you need to understand, what costs can they recoup? How does that all play out at the back end once your game's released and you're starting to make sales? There certainly can be some hooks that you don't realize. So especially if you're going to enter into an agreement with a publisher, talk to a lawyer and probably talk to an accountant too. If you don't understand what convertible notes and shares and debt and loans are, then talk to an accountant or a lawyer or do a bit of Googling. Even grants, just understanding, you've got like the code funding contract, it's actually pretty good. I've reviewed it a number of times. And it's still worth just understanding what you're getting yourself into. So, I mean, that's probably the key point actually, if you are taking on money from anyone, is what are you getting yourself into and what's the end game? What do they want out of it? If you're getting a grant for free, that's quite different. They probably just want to support the industry, support an area, whatever. If you're taking money from a venture capitalist, from a VC, then they probably want a 10 times or 20 times return on their investment. If they're giving you $1 million, they want to sell for $20 million, which means you have to be a $100 million company. That's quite a different kettle of fish from an angel investor who says, I'll be nice, I'll give you 50 grand and, hopefully that turns into 70 grand in 5 years' time. That's quite a different expectation, and it is really worth having those discussions around what does the future look like, for when you're talking to the investor, what do you want from this company? Because you can grow like this and get really big, or you can kind of just grow like this. I don't know which way to go. I'm should be going that way. So do have those discussions, and just be aware, anytime you're taking in someone else's money, it's a level up in your obligations. So when it's just you and your own money, you can be a bit more lax with directors' duties and Companies Act, company law requirements, issuing shares and things like that. When someone else comes on board, you've got more obligations and bigger consequences if you get it wrong. There was a case recently, or not a case, it should be a case, someone should be getting sued. A company that 3 guys did on Pledge Me and got in 300 grand or so, and immediately spent some of it on a Mustang for 50 grand. And then other expenses for themselves, which is, you'd think borderline criminal, but maybe not. We'll see how that one plays out. Look, there's laws and there's obligations, and I mean, from an investor point of view, you hope that there are teeth to those obligations. So, do take some care. I think now we can talk about choosing an advisor, and you can take this with a grain of salt. Obviously, we're going to come in with a certain viewpoint, but Jamie, I'll hand over to you and then chip in with a few more points.
Cool. So choosing advisor. So I was just thinking while Wade's talking about summarizing in as short as possible the things we've talked about today, and most of those about managing your level of risk. Most of the time you can't remove the risk entirely, but you can take a few steps that will put some limits around it, or ring fence it a little bit. But at the end of the day, most things you can remove the risk entirely. You can manage it, you can understand it, and you can plan for it, is probably the things. And especially when it comes to the leveling up with obligations, once you start taking other people's money, that's really where the rubber hits the road and it gets serious. In my Mustang, if I was one of those Pledge Me guys. But the thing is to make sure that you understand your obligations, you understand what you're entitled to in terms of some of these contracts, because some of these things we've seen before, Wade, in things like in convertible notes, particularly, where at a certain point of time a debt converts into shares, there can be some pretty horrible loopholes for the founders or co-founders that are sort of hidden in the fine print, I guess. That can put a big burden on your studio when you're really just starting to take flight. So yeah, just be careful with Not everybody's nice. That's probably the advice. Hey?
And
so
I was just going to say that there's lawyers and lawyers, and there's accountants and accountants, right? And I mean, we've seen one recently where they got some advice and got some money in, but it wasn't set up properly. And, you know, maybe there was a miscommunication, let's say that, but the lawyer used a structure that just doesn't work. And now, you know, they then had to unwind it and spend some extra money and, you know, some goodwill of their investors to try and sort it out, because otherwise it would have just stopped them from raising further money at all, which would have killed the entire business. So we talked there about generalist or specialist. I'm probably leaning more and more towards, you know, make sure the person you're talking with knows what they're doing. It's helpful if they know gaming. We're probably still in pretty early stages of lawyers and accountants that really do understand the gaming industry. There are a few around, but make sure even if they don't understand gaming, they at least understand, you know, technology and growth and whatever you're seeing them for, if it's an ESOP or investment or whatever, and, you know, use the right tool for the right job. Not to call myself a tool, but you know, there you go.
To get the right outcome. And the don't ask too early or too late is a bit of a tricky one, because we never know when something's too early or too late till after the fact. But if something's coming up, like somebody wants to invest, or you think you're having a bit of a wobble with co-founders, talk to your lawyer or accountant and say, do I need what's the best approach? Because most of the honest ones will say, look, this is something you can probably sort out yourself if you do X, Y, Z, but if it's something more serious, then they can help work out a process for you. Always, before you go to meet with an advisor, particularly in the early stages where it can be more about saving money than saving time, ask them what you can do to prep beforehand, because most professionals like us charge based on time. So if you can do some of the pre-work before you get there, fill out forms or do some research or think about your structure before you get there, it can save a whole lot of time going through some of that stuff when you're in the room. Luckily, Wade's nodding in agreement. He's not disagreeing with me. And as a general rule, undoing the wrong thing is usually more costly and time consuming than doing the right thing up front, in terms of getting your structures and things correct and making sure that money goes to the right places and all those things. So yeah, that would probably be my advice. I think we've managed to sneak in on time.
I think so. The last point there was just that as a general rule, and I can say this more than Jamie, you probably need an accountant before you need a lawyer. You know, having an accountant means, or some form of accounting help, whether that's a family member who studied accounting for a couple of years, or whether it's a fully fledged firm. You want to know your financial position. That's one of the most important things as a company and as a business. So that's really, really important. If you only had $1,000, probably spend on an accountant rather than a lawyer, because you can probably get away without a lawyer for slightly longer, until you can't, of course. But let's not worry about that now. And yeah, try and figure out what to do yourself and what to get an advisor for. And remember, your time's valuable too. Anyone, not anyone, but anyone can do the legal or the accounting side just to an extent, but you're the only one with a vision, with the idea of what the game should be. Your time's really important too. So do value that, and it may make more sense to outsource it, even if it costs a little bit more.
Yep, just to free time. Yep. And at the end of this, we might send a copy of this handout to Carl afterwards if anybody wants it, but there's some resources on there. I'll just flick forward to Companies Office, IPONs for intellectual property, Kindrick.co.nz is the lawyer I was talking about earlier. I'm pointing at the screen which is the one you can see, which is to my over here. Has got templates and stuff, some quite good like contracts, just all sorts of different templates, but bear in mind that they are general. So if there's any, they might be your starting point, but they may need to be reviewed by your lawyer. And also get in touch with your local startup organization that they they've got huge ecosystems of people that they can put you in touch with, even if it's just someone who has been through the process of getting their studio up and running, or somebody who's, you know, had to take on people, even if it's just more of a mentoring relationship rather than anything too hard and fast.
Yeah, there's also things like regional business partners where you might be able to access some funding to get advice, yeah, other resources and things out there. And again, if you go to hopefully your local startup support organisation, like Startup Dunedin or Creative HQ or Icehouse or Ministry of Awesome, there's a few different ones around depending on where you're located. Also, yeah, someone like Code are really great at, you know, being able to help. And otherwise, yeah, do talk to your lawyer or accountant. We're happy to, just looking at some of these chat questions coming through. If we go back a slide, we've got our contact details. Always happy to have a chat, you know, for a little while anyway. If it's up to 10 hours, that's probably a bit much. But, you know, we've got our emails there and our LinkedIn. Do reach out and say hi. I like hearing about people who are making new games. I particularly like hearing about the game. It definitely helps me to know that you're making a co-op fantasy action RPG or a, you know, platformer or as a puzzler or whatever. You know, I like kind of seeing what weird and wonderful ideas are coming out in New Zealand, and there's some really cool games, you know, hopefully launching later this year or next. So yeah, feel free to get in touch, and happy to have a conversation and go from there. And yeah, we've got time for some questions, I think.
Yeah, awesome. So yeah, thank you so much, Wade and Jamie, for your time. Just a bit of a recap. Like in this chat, we learned about setting up your business or your studio as a business, advice for hiring talent, hiring contractors, hiring employees, and what that entails. Advice for IP and how to set that up so that you're best positioned if you're looking at getting acquired or anything like that. Investment and advice for when you're taking on money and different kind of definitions of what that might be, and then advice on advisors and who to look out for. So really incredible overview, and I agree how every one of those points could have been their own 1-hour webinar. But I really love that this was a chance just to give that high level overview and just to establish the terms that people can then do their own research and go look online to ask further questions or reach out about things in further detail. So I really appreciate having the chance to have this this kind of high level overview that people can just kind of, start to learn the terms that they need to understand. I'll just read out the questions that are in the chat. So this one comes from Nathaniel. He says, I would love to own and operate a game development company which is registered in New Zealand, but I want to live overseas where the cost of living is cheaper. Is this something that is common? Do I need to register a company over in the country that I'm living, or would I be allowed to contract out work to the locals of that country? General tips, tricks, and advice. What are your guys' thoughts on that situation?
Yeah, I think the simple answer is there's a bit to work through here. Anytime you kind of add in an overseas just makes things slightly more difficult. Doesn't mean don't do it, but it does mean you need to think about a few things. If you've got a company in New Zealand, you need at least one New Zealand resident director. And if they're not New Zealand resident, then they need to be Australian resident and a director of a company in Australia. There's some leeway if you're, overseas for a short while, but that's probably your first issue. And the reason for having a New Zealand director of a company is so that there's someone to sue, basically. If you just had overseas directors and the company does something dodgy, no one's going to be able to actually do anything against that company. So there's a good reason for that, but that might be a little problem for you. When you are engaging others from overseas, you do get into tax questions and revenue questions as well. So yeah, a little bit to work through. It's probably worth working that through. Oh, and I will jump into the next one if that's right, Carl. What key legal watchouts should be considered when working with publishers? That's a whole other talk. This is what I'm going to keep saying. It's an hour-long talk or more. If you search for killer contract, contract killers. There we go. Contract killers, publisher agreement, game development, something along those lines. You'll find a series of articles written by Tim Reaper Davies from Sheridan's in the UK. I caught up with him a couple of weeks ago. Really nice guy, and he just does gaming clients. So he's got about 9 articles on things to watch out for on publisher contracts. That's a really, really great resource. Have a look at that for the first instance. They're all on his LinkedIn as well. I will probably do an article on, along those lines at some point. That's probably the easiest tip I can give. And sorry to dominate the airwaves. Speaking of that, if there are other questions you have that we can't cover today, feel free to send them through. I'm always keen to know what you'd like to learn about. I've got some articles on my LinkedIn, especially around shareholders agreements and companies and IP and employees versus contractors and all that sort of thing. We've got my GDC talk from last year is up on YouTube, which also covers some of this material. So there's resources out there, but let me know what other topics you'd like, and then I can write an article on that pretty easily. I'll also be at NZGDC this year again on the Friday, and I'm going to be talking about the key legal mistakes that game developers can make. So that should hopefully be a really interesting talk too.
Amazing. Thank you, Wade. Was there anything you wanted to add to that, Jamie?
No, I guess the operating across borders, which is particularly prevalent in the in gaming and other online industries, doesn't fit nice and tidily into things like our legal and tax frameworks, because each company's trying to grab their bit of the pie, and so some of the rules for those things are still catching up, so it can get a little bit dicey. So yes, but as Wade said, you can't have a New Zealand company and have nobody present. Can cause its own problems. So yeah, do talk to somebody. And each country's company rules are completely different too. So New Zealand's got pretty lax company rules, for one of the better ones, or pretty broad and pretty easy to get going. Others are much more restrictive. And I think we've got a question on here about somebody who's started a game as a hobby and has a company with a little bit of money coming in, and whether they need to get an accountant or not. It's entirely up to you. There will be a company tax return that needs to be filed, and in theory, a company needs to prepare a set of accounts that follow the financial reporting rules. But I'll leave it at in theory. But it's the most important thing from a government point of view is they get their tax revenue. That's what they want. So filing the tax return is your most important thing. But I mean, do get in touch with somebody if they might be able to point you in the right direction. There are templates for accounts and things out there. But yeah, I guess the difficult thing when you've got a company to remember is, even if it's just you working there, the income and the cash that arises from that income belongs to the company. It doesn't belong to you. So that's sort of a thing. I mean, there's tax rules that deal with people who are earning all the money in their company to make the income flow through from a tax point of view, but in a legal sense, the income earned by the company belongs to the company, so you can't just take it. That's probably the short answer.
Yeah, I think that's a great perspective to have, is that when you're established as a company, that money, even if you're the only one that's a part of it, that money is not going straight to you, it's going to that company. Wade, was there anything you wanted to add to that?
No, just that, I think you mentioned a couple of $1,000s. If you get a couple of $1,000s and you want to get some advice will probably cost you $1,000. So it probably doesn't make sense at that point. You maybe just take the risk. Apart from for things like transferring IP into the company. So it is always a question of, what's this going to cost me in cash? What's it going to cost me in time? And what's it going to cost me in risk? A couple of grand, you might be okay. Poke around online and see what you can find.
And someone else mentioned there that filing things like that yourself, you might raise your risk of audit by Inland Revenue or whatever. Inland Revenue touch wood, lately in New Zealand is not particularly focused on auditing people. They do risk assessments across different industries, and they send what they call information requests, which is not a formal audit. They just ask for more information, which is not necessarily alarming. But if you do get something like that, I would talk to somebody, because you can inadvertently send them information that they don't need. So they don't, I mean, they're gonna, if we use our few $1,000 example again, from a risk point of view and a cost point of view, IRD is probably not going to audit that company, but they may send you some, asking for some more information, or they may, so just make sure you file the right forms. It's obviously a lot easier now with My IR, but filing it electronically, but do the right thing. That's all
Awesome.
I can say.
Thank you so much for both of your time. I think what I'd love to do is, if anyone listening is still here, clearly these questions are really valuable, and the questions are still coming in, which is really great. I would love it if you're listening to this and there was any area that you would want more detail on, we can definitely invite Wade and Jamie back to go into more detail on a certain topic. That's something I'd love to see, just as the community grows together, to kind of go into more detail on the areas that we think are the most important. So feel free to reach out either on Twitter at NZGDA or info@nzgda.com, and just let us know what areas you'd like discussed more, and we're more than happy to help arrange that conversation. And also, just in terms of promotion, if you enjoyed this podcast, feel free to share. I say podcast, webinar. If you enjoyed it, just tag us on Twitter at NZGDA, and we'd just love to know what resonated with you, what bits you enjoyed. That really helps us when looking at what to do next. So thank you so much, Wade and Jamie, for your time. I don't want to take up any more of anyone's time. This is being recorded and will be put on YouTube at NZGDA if you're interested in following us there. So to close off, I'd just like to pass it back to Leanne to give us our closing karakia.
And thank you, Wade and Jamie. We know that you usually charge for your time, and you've given your time and your expertise freely to this community numerous times, and you continue to. So this is just a thank you for that, and a formal goodbye until the next time. Unahia ki te uru tapanui, kia wātia, kia mama, te nākau te tinana, te wairua i te ara takata, koira I rongo, whakairea ake ki runga, kia tina, huie, tākie. Thank you both today.
Thanks for having us.
Thanks for having us. Pleasure.
Cool. Thanks, team. Have a good rest of your day.
Everyone.
Happy day, everyone.